The latest data from the Center for Monitoring the Indian Economy indicates that investments plunged to a 14-year low in the December quarter. The stalled projects remain at record levels. This at a time when we thought that the results of L&T and Cummins and ABB are all showing better order books. This dissonance in terms of the actual numbers on the ground is kind of disturbing this capex cycle expectations. To discuss this theme further, we have with us the person who directed this entire report, Mahesh, Vyas, Managing Director and CEO of the CMIE. Thank you very much indeed for joining us. Just give us your picture of the last quarter's investment performance. Some of the capital goods companies led us to believe that something positive is happening in terms of capex.
Well, the capital goods companies could be doing well, and we will not dispute that. The numbers at a macro level for investments are, as you rightly put it, sobering. So we see new investment projects being announced actually falling, and this is not a plunge. It is not a sharp decline, but is a part of a steady decline that has been happening for the last 3.5 years. So if you do a proper time series analysis of this, and we did that recently, and we found that this is actually a trend that began somewhere in 2015 June, and after that investments have only steadily declined. So now you reach a point where you become a 14-year low, and this seems to be a part of a trend. If you keep on falling, you will become a 20-year low as well. So, A, this is part of a trend. B, there were expectations in June of 2018 that there will be a revival. We did see some projects increase in proposals being made. We saw an increase in the order book flow, and we anticipated an increase to come about. But that hasn't played out. The new investment proposal is still very, very low. The second thing is that there is also a fall in the revival of old projects. So you have a decline in revivals and you have a decline in new investments. At the same time, in the December 18 quarter, we saw an increase in the stalled projects. There was one big 3 trillion ton refinery project in Maharashtra and Konkan region which got stalled. So you see this increase in stalled projects and decline in new investment projects leads to a fall in the outstanding projects itself. So we are seeing the stock of investments on hand actually having fallen and fallen quite a bit.
Mr. Vyas, what would you guess are the main reasons? Is this a financing issue that banks have a hole and therefore they are not able to finance these projects? Or is it that there are too many projects that have been completed, like power, for instance, and not used and being dragged to the NCLT? What could be the reason for this long drought?
It is not a financing problem. That is clearly ruled out. So we even asked entrepreneurs questions as to why a project is stalled, etc. And the only people who say financing is a problem are those people who are actually not bankable. So if you really have a very difficult balance sheet, then obviously you have a financing problem. But if you have a decent project, then nobody says that financing is a problem. The recent refinery that got stalled because it had land acquisition problems, and it just couldn't get off the ground. The problem, you rightly pointed out that a lot of projects have been commissioned already and capacity utilization is still low. So the expectation of capacity utilization rising, what we saw in Obicus in June 18, has actually come down again. So the problem is more to do with demand.
Mr. Vyas, definitely not great thoughts as we're looking at 2019. But, the point is that I'm looking at the quarter-on-quarter drop, and that's also a little disconcerting. The 62% fall in private sector projects quarter-on-quarter. Because, I mean, a lot of the companies that we were speaking to seem to be giving the indication that, some kind of brownfield expansion, etc. is starting. We heard a lot of players talk about at least 80%, capacity utilization. Now, if indeed we are at 80%, should this not be close to an inflection point when the pickup actually starts? Do you see that anytime in the near future, or do you think election uncertainty will perhaps keep plans on hold?
So two things. One, don't read too much into the year-on-year growth rate. which you see a 60% plunge, because the latest figures will get upgraded, will go up. So if the total investment proposals in December 18 quarter were about ₹1 trillion, I expect it to go up 40% at least, 40% thereabouts. So this will go up, and the 60% decline will look a lot less troublesome than it looks now. So there are revisions that come in due course of time. The second problem is that if the companies are saying that they are seeing 80% increase in their order books or so on and so forth, I think that's true as well. So I think the larger companies are doing well, and the existing companies are doing well, but new ones are not coming in. There are sectors where you will not see big investments, like power will not see big investments. There is a very good ramp up in investments in the road sector, and that has continued, which will show up in the balance sheets of implementing companies. So there is some story, there is some truth in what the companies are saying, but the larger picture is still not very good.
Okay. Maybe you can put all these pieces for us together, because we were running away with the idea that there is an incipient capex. You know, the GDP numbers, the gross fixed capital formation numbers, the last number we got was 12% higher. For the last 6 months, the IIP numbers, the capital goods number has been in double digits. The Reserve Bank, when it presented its monetary policy, you know, they gave some outlook of the economy. They said long-term utilization has gone to 76, which is higher than the long-term, capacity utilization has gone to 76%, which is higher than the long-term average of 75%. Where is this dissonance then? What kind of reality are they talking about? And, you know, your numbers are the cleanest because they are actually going to the micros. How will you reconcile these two?
So let's take the RBI numbers. So RBI says 76% is higher than the long-term average of 75%. But the long-term average consists of a lot of ups and downs.
Okay.
Investments pick up when capacity utilization is at the higher end, not just a shade above the long-term average. So that argument doesn't hold. A. B, it's not 76%, it's a shade lower than that now. So the RBI's argument is only partly correct. Now you go back to the IIP and the GDP numbers, etc. What they are looking at is essentially growth in production of steel, cement, and some machineries. Now, all these have done slightly better because you do see this in the growth in roads construction. Roads construction does take a lot of cement and steel and does take some machinery as well. So a little flip over there does show that investments are growing. But the larger picture of all investments put together is still dismally low. We are seeing completions of projects getting actually delayed substantially. So I think all the numbers are saying is right, excepting RBI, I think is a little overstretched argument. But I think all the numbers are only giving a small picture.
Mr. Vyas, a word also on the public sector capex side of it, and government spend. They've already spent so much in the year, and now with the tight purse strings, I don't know what more is possible. But how do you think this is going to shape up the overall picture for FY19 ahead of elections?
So at least from our capex database, we do not see on the capex front traditionally the government playing a counter-cyclical role. So when investments go up, public sector and private sector both increase investments, and when they go down, both come down. But now note this, in the last 2 years, we have seen the government actually acting counter-cyclically. So road investment that I keep emphasizing is doing much better than the entire trend. The problem is the path forward is getting hazier because competitive politics is leading to a lot of the resources being frittered away into loan waivers and a whole lot of other things, which will leave the space, the fiscal space for counter-cyclical activity to be very limited. So I see this good action from the government in the last 2 years to possibly getting strained in the coming years.
Okay, well, not looking too good. Thank you very much, Mahesh Vyas, for being with us and explaining in great detail all that your own survey has found and how that can be reconciled with the kind of numbers we are getting elsewhere.